Hello and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Tuesday, July 5th, 2022, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, we have futures a little red. We started off green yesterday in the evening hours, but it did turn overnight. We're now showing Dow futures down about 150 points. S&P 500 futures down about 20 and the NASDAQ futures down about 85. So on a relative basis, looks like the NASDAQ might get off to a little bit worse start. Crude oil prices down fractionally, down to about $108 a barrel. That's about 35 cents lower. And the U.S. 10-year Treasury yield, maybe down close to 1 basis point, relatively flat, sitting at about 2.90%. But that is somewhat significant because we did break back below that 3% level. And it was just a couple of weeks ago that we were at 3.48%. So anyway, that's had a pretty big drop and definitely an impact on the market. We'll see if that 10-year Treasury yield continues to drop. I think that would play into the bulls' hands if it were to happen. But again, we'll wait and see. I'm kind of watching 270, and I'll talk about that in just a bit, 2.7%. All right, let's go through the agenda for today. So we're going to start off with, well, as we always do, we're going to start off with the daily market recap. Then we'll jump into talking technically. Earningsbeats.com mailbag. I'm going to go into a couple of very interesting questions that I think you might find interesting. Then earnings spotlight. We'll wrap up with 3 you must see. Before I get into any of that, though, let's go over to earningsbeats.com. For those of you who are new, if you go over to earningsbeats.com, you scroll down, you will find this area here where you can sign up for our free Earnings Beats Digest newsletter. It's a 3 times a week newsletter coming out Mondays, Wednesdays, and Fridays, typically around 8:30 in the morning Eastern, just about an hour before the market opens. All it takes is a name, email address, hit that subscribe button. There's no credit card required. You can unsubscribe at any time. And you'll just, learn a little bit more about our approach and how we look at the market. We try to make this very educational, though, many subscribers use it for trading opportunities as well. That's completely up to you. But I think you'll find a lot of the information very useful. We look at things like earnings and gaps and relative strength, trend lines, moving averages, candlesticks, price volume, those types of things we use in our trading arsenal. And I think, again, if you follow along, maybe you'll just pick up some things that can add to some of the things you already follow. Anyhow, go over to earningsbeats.com, scroll down, make sure you get that subscription set up. We do have free webinars from time to time. We always reach out to our Earnings Beats Digest community and offer up room instructions to come join us. So that's another benefit of being a member there or a subscriber there. All right, let's talk a little bit about what happened on Friday before the long weekend. So this is your daily market recap. Dow Jones Industrial Average finished up 322 points, S&P 500 up 40, NASDAQ up 99, mid caps 27, small caps 10. So on a percentage basis, everything was up close to the 1% level. A couple of the indexes a little bit more than 1%, a couple a little bit less than 1%. Looking at the sectors, utilities up 2.5% on Friday, big day for utilities. Discretionary up 1.8%, real estate 1.8%, energy 1.5%, staples 1.44%. One group that was missing there and definitely lagged on a relative basis was technology. But I will say all 11 sectors did go up on Friday. So haven't seen a whole lot of that in 2022, but all 11 sectors higher on Friday. 10-year Treasury yield. All right, so today we're relatively flat. Did want to mention, I talked about that 270 level that I'm kind of watching. So if I annotate this and then just bring this level out right over here, it's right about there. I mean, you can see these bottoms. After we went up to 280, we pulled back to about 270. Again, later in May, maybe not quite all the way down to this low, but probably low 270s. And then we made this run up to 348. Now, the breakout level was above 3 318 or so, 319. And if we went back about 10, 11 years, you'd know that there was a top, or actually not even 10 or 11 years, but over the last 10 to 11 years, the high has been around 3.25 prior to this breakout. So we had these 2 days where we went up, got above that 3.25 level, and then quickly gave it up. Now, I don't know at this point whether or not that's going to turn out to be a long-term head fake, where we went through the 3.25, failed, and then we started coming back down. I think that is a very real possibility. Or whether this pullback here is just going to be short-lived and we're going to go right back up to all-time highs. I think we are not all-time highs, but 11-year highs. If we turn back up and go back through the 350 level, that is going to definitely argue for lower equity prices. And I am on record of having called the bottom on the S&P 500 the week, well, it was the mid part of June. So I think it was June 16, 17. I actually think I did the video on the 14th of June, but we were getting ready to have a Fed meeting. And I simply said, with the Fed and possible Fed hangover, whatever the low was that week, I felt like that potentially would be the low. So it did go a little bit lower than my video when I was on the 14th. But I did say, that I thought later that week we could still see a little bit more fallout. And that's what we did. I think it was June 16th or 17th. We got down to a low of 36.36 on the S&P 500. Anyway, I think if we see this 10-year treasury yield move back up and break out, I would not be surprised to see the S&P 500 go lower. This would be one scenario that I would be a little bit more concerned with. I'd have to see how all the other ratios that I follow look like as well, and I'll show you some of those in just a minute. But yeah, I wouldn't feel great about the 10-year treasury yield moving up, because if the yield's moving up, it tells me that the market's still concerned about inflation. If the yield's moving down, then it's telling me the market's moving past inflation and is now more worried about the recession. Listen, the Fed's got two battles to fight. They want to win the inflation battle, and they don't care about the recession battle right now. So for me, and I think long-term, we saw what happened in the 1970s when inflation spiraled out of control for a long period of time, the pain that everyone went through. If we're going to be in that kind of an environment, yields are going higher, because no one in their right mind is going to buy a 10-year treasury yield yielding 3% if inflation is going to be 6, 7, 8, 9, 10, 12%. It makes no sense. So you wouldn't be buying bonds. You would sell bonds, which means yields would go up. So this is going to be one important piece of the puzzle to watch. I am going to be much more bullish about the stock market if the yields can come back down and start to trend lower, or even if they just go sideways. I'm not going to be as bullish on the market. Of course, I want to look at all my other signals, but in general, I'm not going to be as bullish if yields are rising. So this is going to be one piece of the puzzle to continue to watch. All right. So the S&P 500, obviously we're in a downtrend, topped beginning of January, been trending lower, lower lows, lower highs ever since. So it's hard to just look at this chart and be bullish. And I don't look at this chart. I'm not looking at this chart and being bullish. I'm looking at other charts and starting to become more bullish. The S&P 500 clearly trending down. The AD line, I think, still looks pretty good. As we move down, AD line was pretty much just putting in higher lows, even though we're putting lower lows in price. We've seen that continue throughout 2022. One good week and the AD line probably be at an all-time high. So that's at least one piece of the puzzle that suggests there's a lot of accumulation taking place, even though prices have been going lower. Somebody's accumulating, and that somebody is Wall Street. So that's, one argument that I would say why this is a cyclical bear market as opposed to a secular. And I'm going to talk more about that. That's an interesting question that I want to address. But just looking at this chart, I think it's pretty easy to visualize the fact that this chart is moving lower from left to right. It was going into the end of the year moving higher. Now it's moving lower. So until that changes, it's hard to be really bullish. Might start seeing some bullish signs, but that doesn't mean the market's going higher. It just means that perhaps we're bottoming. And so that's kind of the stage that we're in right now. So here's a chart of the S&P 500. And this was the low that we saw back on May 23rd. So if you go over to the daily chart, see this May 23rd low right here. What I'm doing is I'm looking, well, I'm not really looking at these two lows. What I'm looking at is where we were on that May 23rd low and where we are now. So this is an hourly chart that goes back the last 6 months. So here's your May 23rd low, or actually right around the 20th, maybe the open of the 23rd. And this is where we are now. The S&P 500 has been roughly flat now for about the last 6 weeks. Haven't really seen a whole lot. I mean, this is where we were on May 23rd. This is where we are now. Up, down, back up a little bit on Friday. But essentially, we're flat. But what's happening within the market? Where is money rotating to? Where is money rotating from? Those are kind of important questions. It's not just about the S&P 500 being flat. It's about Wall Street. It's about rotation. What's Wall Street expecting? They don't buy stocks because of what happened in the last 3 months. They buy stocks, they move into various groups because of what they expect to happen over the next 3, 6, 9 months. So it's always important to see the rotation taking place. NASDAQ versus the S&P 500, pretty much just flat. You know, I mean, at these lows, May 23rd and then middle of June, those lows, you could see that we were starting to turn back up again. And that was one of the things that got me bullish. Looking from May 23rd to where we are right now, we're kind of flat. So some of that bullishness has waned a little bit, although we still haven't put in a new low on this relative chart, even though we did put in a new low on the S&P. So I still say edge to the bulls. XLY, XLP, this one's making me a little nervous. If there's one thing that's making me nervous in the market right now, I'd say it's probably this chart right here, XLY, XLP. Since May 23rd, it's actually gone down a little bit. It was looking good back in mid-June. Remember, S&P went lower and the XLY, XLP was higher. But that's not been the case now. These past couple of weeks, we've seen this turn back down again. So that's kind of, I'm going to give the edge to the bears on this one. IWF, IWD, this is growth versus value, large cap. Still trending higher. So I'm kind of liking that. Large cap growth versus large cap value. This is the Dow Jones index. Still slightly higher. So while the S&P has been going sideways, we're seeing a little rotation into growth versus value. So both these charts, I would definitely say, are more bullish, giving the bulls a little bit of an edge. Mid-cap growth, I think, has really started to turn up versus mid-cap value, and the same for small-cap growth. So I'm going to put pretty good sized check marks in the bulls column for these two. But then transports, utilities have turned back down again. Utilities have done, pretty well. I was not expecting that. Utilities have come roaring back. Transports not so much. And you can see the relative weakness here. I will say, though, that all of these, what I consider to be sustainability ratios, not one has broken to the low that they previously established back in May. So I'm going to still stick with what I said before. Maybe I'm a little bit more cautious about it, but I'm still pretty bullish, still pretty confident that the bottom is in. But I've been asked, well, what would make you think otherwise? What would make you think that was premature? Well, if these ratios turn back down and set new lows, I'm not going to feel good about the market bottom being in. Doesn't mean it couldn't be, but I'm just saying, I always talk about odds. I always talk about, what makes common sense to me. And it's more than just whether the S&P is going up or down. I mean, yeah, it's been going down all year. These ratios have been going down all year. I mean, there's the S&P since back the beginning of January, down a little bit of up there, but for the most part, this has been down. Same thing for these ratios all year, setting new lows with the S&P 500, every one of them. Now they're giving us a little bit different look. And that's why I think we have to at least be considering the fact, and I'm doing a little bit more than that, but I think we have to at least be considering the fact that the bottom's in. All right, I'm going to move on to the earningsbeats.com mailbag. And there were a couple of questions I thought were worth talking about and addressing here. And the first one is, can you explain secular and cyclical bear markets and how you can tell the difference? And I think this is probably a question that a lot of you might have. So I thought this was a great question to talk about. This is a 100-year chart. I always show this. And when you're looking at the big picture, I think this is where you can really help to see it. It helps you identify cyclical bear markets versus secular bear markets. These red shaded areas that span over a decade, and in this case, 2 decades, these are secular bear markets. So imagine if I said that the high at the beginning of January of 2022, 4,800 on the S&P 500. Imagine if I told you that this S&P 500, we would not clear 4,800, or we would not clear that all-time high until maybe year 2035. 13 years from now. That's what you'd be looking at with a secular bear market, where we topped here in the year 2000 and didn't break out meaningfully above that top until 2013. Now we had a big bear market.com bubble. Then we had a cyclical bull. Cyclical bull markets are bull markets that occur within a secular bear. Got right back up to the prior high, and then we had the financial crisis. And so it's a period of time where money is just simply rotating away from equities. So a lot of it was rotating into the bond market, because the bond market was, the yields kept coming down. A lot of it also was rotating into gold. Gold did really well, especially back at the beginning of this secular bear. So that's what a secular bear market looks like. The 1970s, another secular bear. Here we got up in 68, late 1968 to a high. We did go slightly above it. But if you notice these lows, you see this low here, pretty scary low back in 1970. That took us down to about a 6-year low. We went up one more time. And then when we came back down, we took out that low in 1970, slightly lower low, before we launched what ended up being a breakout into a secular bull market. Well, if you look at the 2008, 2009 financial crisis, notice we went back and we took out this prior low, which, by the way, was about a 7-year low. This one over here was about a 6-year. Actually, we could probably go all the way back here. Might have been about a 7-year low, 64 to 71. In right around there, 63, 64 to 70, whatever, 6-7 years. Very similar to what we did here. Rallied back, go back down to one final low that really scares everybody. Here, come back down to one final low that scares everybody. And then we're back off again. Here, off again to the upside. Now, so these secular bear markets that are shaded in red, first of all, they extend over long periods of time. Cyclical bear markets tend to be pretty shallow in terms of duration. In order to have a secular bear market, you really need to see your monthly PPO go negative. If you're only weak for 3 to 6 months, your monthly PPO won't go negative. If you look back at the cyclical bear markets back in the 1950s and 1960s, these little short little pullbacks, Notice where the monthly PPO goes down to, right about to the center line, and then turns back up again. In the secular bear market, the monthly PPOs go very negative. Then you go into a secular bull market, and once again, we stay positive. Blue shaded area staying positive. Then we have this secular bear market. Look at us go way negative again on the monthly PPO. Now we're in a secular bull market. There's that blue shaded area. We're coming down, but we're just coming down to here. We did the same thing. This was 1987. This was 1991. This was 1998. All of these saw the monthly PPO dropping, but they never went negative. The one we have right now, we're dropping, but we're not negative. We're nowhere near it. We're still 4.5. So when people ask me, well, what will make you believe that we're in a secular bear market? Well, that monthly PPO is going to have to go negative, number one. We don't know if that's going to happen or not, but it hasn't happened. And whether you're in a secular bear market or a cyclical bear market, from the beginning, the first several months, it doesn't matter. They both go down. One doesn't say, well, I'm a secular bear market, so you lose more money. No, cyclical bear markets, you lose money as well. Same thing. We're pulling back. The pandemic turned out to be a very quick cyclical bear market. It was very quick, lasted 4 weeks, right back up again. 2018, fourth quarter. That was a cyclical bear market. We went down 20% in 3 months, right back up. If you look at the secular bear markets, they start off the same way, going down. It's just that instead of just going down for a few months and then rallying back up, they keep going down. 2 years, 2 years, 3 years, 2.5 years. I mean, I don't know. These back in the 30s, I mean, it's hard to say where the start and stop is on some of these, but it goes down for multiple years. Cyclical bear markets are down right back up, down right back up, down right back up. I believe this is going to be a cyclical bear, down right back up, because I think that we're in a long-term super cycle of strength. Bull market going higher. I think money, we're in a super cycle of money rotating into US equities. So I believe it's short term, but that's basically the difference. Another question that came up, can you show sector rotation on RRGs and what you would look for? Now, what I did is I pulled up a 1-year chart. This is the benchmark. So we're rotating around the benchmark. The benchmark is going to be right at this center point where the two axes meet. That's the S&P. The 11 sectors rotate around it. When it's leading the S&P 500, you'll see the sector over here. When it starts to weaken, it drops here. Then it goes to lagging, or maybe it goes from weakening right back up to leading, but they tend to move in this direction. Northeasterly, back down to the south, southwesterly, back up to the north, northeasterly. This is the way they rotate through time. So you can look at all of these. All I'm doing is starting a year ago and dragging this. This is the S&P. So as the S&P is doing this, up, down, you can watch to see what the various sectors are doing. And so you can see what's leading and what's not at various times. Notice the XLE is over here. It's going up and down, having all kinds of fun, but it's on the left side of the chart, which means it's got awful relative strength. And so just kind of watch. And if you want to see what the XLE is doing, you can just focus on that. Click on it down here at the bottom, and that will give you. And then you can just go through here and just see where the XLE goes. Whoa, look what just happened here. One of the things Julius de Kempenaar talks about is when you get these big moves, these long tails over here to the downside, or excuse me, over here, this is actually to the upside. But these long tails, these are powerful moves. Here, it's like it's just kind of meandering in a fairly tight range. But when you see that shows power. And notice it stays over here now. Goes down to weakening, goes into lagging. This is back at the end of last year. It really looks bad again. And then watch as we get into 2022. So here's the end of 2021. And then look at the early part of January as the money starts coming out of many of the other sectors. Look at energy take over and where it has been throughout the rest of 2022 until just recently. Watch this. I'd be careful with energy. I mean, I can see it on the chart, but you can really see it here. This is just 5 days. The tail length is 5 days. So it's showing you where it's gone these last 5 days. It's gone from significant relative outperformance way over here on the right side of the chart to significant underperformance in 5 days. And remember, that's what happened at the beginning of the year that triggered all that strength throughout the first 6 months. So be careful with energy and be careful with materials, because materials kind of did the same thing. Maybe not to the same extent, but it was way over here on the right. And then boom, at the end right here, just exploded over to the left side. Meanwhile, look at what's moving over here on this last move. We're seeing staples and healthcare, two defensive groups moving back over here. I wanted to show you right in here. Now, this was the beginning of the year. So this was January 14th. And you can kind of see, well, I mean, here you got utilities, you got staples, you got energy. Here you got consumer discretionary technology over on the left side of the chart. Not good. That's bad relative strength. Now, I want to show you what happened back at the end of March, early April. When we rallied at the end of March, that was, I think a lot of that had to do with options expiration. But you could see this big move down in utilities and real estate and all the defensive groups. After we topped in early April, look at what happens here. As the market starts to roll back over, look at staples, look at real estate, look at utilities. Money is pouring back into the defensive groups. That's not a good sign for the market. Industrials and financials way over here. Here you got discretionary weakening, technology weakening. Those are the ways you can kind of look at RRG to get a sense of what's going on in the market. So hopefully that helped. All right, earnings spotlight real quick. SLP reports, not really much going on, light volume. I mean, this is probably not even one I pay much attention to. And then the three you must see, when interest rates are coming down like they have been, look at the home building stocks. DR Horton strengthening, trying to get through the 50. Watch interest. That's going to make a big difference. Next, the S&P 500 on Friday. Look at all these semiconductors that were in bad shape. Monolithic power went down, tested price support, trying to bounce off of it. We'll see if that holds. And then the last one I wanted to show you is just Caterpillar. It's kind of fallen apart. I don't like the relative strength all of a sudden of its peer group. Big drop down. It's trying to hold on to support down around 180 or so. Anyway, that's it for me. Have a great rest of your trading day, and I'll be back Wednesday over at Earnings Beats for your next Trading Places Live. Have a great day, everybody. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.